Today, the yield on the 30-year US Treasury bond reached 5.29%. That is the highest it has been since 2007. If that sentence means nothing to you yet, stay with me, because it quietly touches almost everything you own. A Treasury bond is a loan you make to the US government. The yield is the interest rate it pays you for that loan. When the yield goes up, it means buyers are demanding more to lend, usually because they are worried about inflation or about how much the government needs to borrow. Here is why stock investors care. If a 30-year government bond pays over 5% with almost no risk, then every risky investment has to work harder to be worth owning. Money that was sitting in stocks, because there was nowhere else to go now, has somewhere else to go. One of the forces behind it shows up on our global page. Japan is the single largest foreign holder of U.S. debt, at $1.12 trillion as of June 2026. In that 1 month, Japan sold $26.4 billion of it. When the biggest lender steps back, the Treasury has to attract other buyers, and the usual way to do that is to pay more. The macro environment page reads all of this in one view. The 10-year and 3-month Treasury yields, inflation, credit conditions, and how stretched the market is against its own history. Each one is labeled in plain words, so you can see the weather without needing an economics degree. One thing we will not do is tell you what happens next. Nobody knows where rates go from here. What you can know is where they are today, and what that changes about the choice between owning stocks and being paid to wait. Every number here is on the page, updated as the data changes, with the date it came from. Smart charts. The stock market, explained in plain English. Nothing here is financial advice.